Hello again, everybody. Mark Gilmore here with Kestrel Advisors. As I've stated in a few previous videos, the housing market has been overvalued for several years now, but it reached an inflection point towards the midpoint of last year and has begun to decline. As we've stated, we would not be surprised to see the housing market at the national level decline by 20% from its recent peak before it bottoms out, and we expect it to hit that trough sometime between November of this year and May of 2024. However, despite that rapid decline in home prices, we do not expect to see the same sort of widespread foreclosures that we saw following the housing bubble of the mid-2000s. The reason for that has to do with adjustable rate mortgages. Now, before we get to the very particular reason, let's first take a look at the structure of ARM loans. As many of you are already aware, ARM loans generally have two distinct periods. One is the introductory period, where the interest rate on the loan is set at a discount to the interest rate for the typical 30-year fixed rate mortgage for a certain period of time. These days, that introductory duration is often 5, 7, or 10 years. Now that's in contrast to the typical intro periods that we saw in the mid-2000s, which were often only 2 or 3 years in duration. Now, the discount to the interest rate on the ARM loans is often about 1% below that for the 30-year fixed rate mortgage. And indeed, the latest weekly MBA survey shows that that discount was just about 1%. Now, once the introductory period ends, the interest rate will adjust during the adjustment period of the loan. It's not uncommon for that interest rate to jump by about 5 percentage points when the introductory period ends. And while that might not sound like a lot, that often has quite a significant impact on the monthly mortgage payment. Let's take a look at a few examples here to illustrate that point. Under our first scenario, we've got a home that's sold for $350,000, where the borrower has taken out a loan of $300,000 to finance the purchase. This is a 5-year adjustable rate mortgage structure with the initial interest rate set at 4%, and the adjusted interest rate will jump up to 9% once that introductory period ends. We can see here that for the first 5 years, the P&I component of that mortgage payment will be $1,432.25, which is probably reasonable for most borrowers out there. Once that intro period ends, though, and the interest rate increases to 9%, even though that's only an increase of 5 percentage points, we can see that it has a drastic impact on the monthly mortgage payment, jumping it up to $2,277.10. That's an increase of over $800 per month and represents an increase of almost 60% in the P&I component of the mortgage. A lot of borrowers out there might really struggle to handle a sudden increase like that. Of course, as many of you may suspect, the duration of the introductory period has an effect on the severity of the increase of the mortgage payment once the loan resets. I've put together a table to illustrate the effect of that change in duration. As we can see here, under our 5-year scenario, once the interest rate reset, it resulted in payment increases of almost 60%. But if we extend that duration out to 7 years for the introductory period, the impact is a little bit less, resulting in increases of 55%. If we extend that out again to 10 years, the increase is only 48%. Now, I say only with a little bit of a grain of salt. That's still a pretty significant increase in the monthly mortgage payments. Let's contrast that, though, with the degree of severity for the 2 and 3 year introductory periods. We can see here that the effect from those shorter periods is 63 and 65% increases in the monthly mortgage payments in a very short period of time. It's hardly any wonder that so many borrowers defaulted in the mid-2000s once their loans reset. Now, as you may also suspect, the starting and adjusted interest rates may also have an effect on the severity of the increase in the mortgage payments. Counterintuitively, though, the lower the starting interest rate, the greater the severity on the mortgage payments once the interest rate resets. Let's take a look at our second example. Here again, we've got a home that's sold for $350,000, where the borrower is taking out a loan of $300,000 to finance the purchase. Once again, we'll start by considering a 5-year introductory period. In this case, though, the introductory interest rate is 3% as opposed to 4%, and the adjusted interest rate will again jump up by 5 percentage points, this time to 8% rather than 9%. For the first 5 years of the loan, the monthly payments will be $1,264.81. And I misspoke there slightly. That's the P&I component of the payment, not counting the taxes and insurance. After the interest rate resets, though, those payments jump up to $2,058.58 per month. That's an increase of 63% in the monthly mortgage payments, as opposed to the 59% we saw in our first scenario. Again, I've put together a table here showing the effect for various different durations. Again, as we extend the introductory period duration out longer, the impact is lower, dropping from 63% to 58% and ultimately down to 51% if the intro period is 10 years. However, we can see in each of these cases, the effect on the adjusted mortgage payment is higher than it was under our first scenario. And again, if we look at the shorter 2 and 3 year intro periods, we see that the effect on the mortgage payments is much more drastic at 67, and for the 2 year introductory period, 70%. However, despite those alarming numbers, we believe there is much less concern for the housing market today than there was in the mid-2000s. As I mentioned, ARM loans today typically have much longer introductory periods than they did in the mid-2000s. Typically today, those introductory periods last for 5, 7, or 10 years. As we've seen in our examples, those longer introductory periods result in less severe payment shocks once the loans do reset, although those adjustments to the payment are still significant. Secondly, because of those longer introductory periods, borrowers do have longer periods of time in which to increase their incomes in order to manage those increased payments. And periods of 5, 7, or 10 years seem to be more realistic for increasing one's income to manage those increases in payments, as opposed to expecting to get raises or promotions within a period of just 2 or 3 years, as was the narrative in the mid-2000s. And finally here, borrowers have a longer window in which to sell their houses if their plans to increase their incomes or otherwise manage the payment shocks are not panning out for them. But there's one paramount reason that we believe there's much less systemic risk to the housing market today than there was in the mid-2000s. And that's the sheer fact that there's much less volume in ARM loans today than there was back then. Until January of 2022, ARM loans comprised only about 3 to 3.5% of all mortgage originations. Now, in early 2022, that share did begin to rise as housing affordability flew further and further out of reach for many borrowers, ultimately peaking around 12% of the mortgage origination market. Since then, though, it is moderated to a level of somewhere between 6 and 8% of mortgage originations. In contrast, in the mid-2000s, I think it was in 2005, ARM loan reliance hit a peak of 40.5% of all mortgage originations. Just contrasting the percentage of the market that ARM loans commanded then as opposed to what they do now, that accounts for our belief that we will not see the widespread foreclosures we did back then. I hope you enjoyed this video. Tune in again next time for more keen insights from Kestrel Advisors.